Gold is printing $5,000, silver is ripping at $121, and the ratio just flipped in a way almost nobody was positioned for. Here's the danger. The biggest mistakes in metals don't happen in the slow months. They happen right after a headline number hits, when everyone feels right, and the crowd starts acting like the game is already won. As I'm recording this, it's January 29th, 2026, 10 a.m. local time. Drop a comment with what time you're watching, because this move is global, and the next phase will not be driven by one screen. Today we're doing three things, fast and clean. 1. What this ratio flip actually means and why it changes the playbook. 2. The two traps that show up right after $5,000 gold and $121 silver. 3. The simple framework to stay positioned without getting shaken out. Let's start with the math that rewires the whole story. When gold is $5,000 and silver is $121, the gold to silver ratio is around 41. That number matters because the ratio isn't a prophecy, it's a thermometer. It tells you which metal is leading and what kind of psychology the market is in. High ratio usually means fear and safety first behavior. Lower ratio usually means reflation, risk appetite, and silver torque switching on. And here's the part people miss. Ratio moves are not smooth. They drop, then pop, then drop again. The pop is where the crowd gets confused and sells the wrong thing. So if you're staring at $121 thinking, this must be the top, slow down. A ratio flip is often the bridge between a gold-led phase and a silver-led phase. It's not the finish line, it's the baton handoff. Now, why does this flip feel like it came out of nowhere? Because most people anchor to old ranges. They spent years seeing a much higher ratio and they treated it as normal. So when it compresses fast, their brains do a shortcut. It moved too far, too fast, so it must reverse. That shortcut is emotional comfort, not market structure. Here's the real structure. Gold is the door people walk through first. Silver is the room that gets crowded later. Gold moves on trust, protection, and reserve behavior. Silver moves on trust, plus industry, plus smaller market depth. So when the cycle turns hot, silver doesn't gently follow. It sprints, it overreacts, it scares people out, then runs again. Now let's talk about the two traps that show up right here. Trap 1, the victory lap sell. This is when you sell just because the number feels loud. You didn't hit your plan, you hit a headline, so you take profit for emotional relief, and you hand your position to someone who has a plan. If you need money for life, do what life requires. But if you're selling because your nervous system can't handle green candles, that's not strategy. That's a stress response. Trap 2, the fake gold is winning again moment. After a sharp ratio drop, it often pauses. During that pause, gold can look like it's outperforming for a short stretch. That's when people start swapping out of silver at the exact wrong time, because that pause is frequently a reset, not a reversal. It cools down leverage, shakes out late chasers, and rebuilds pressure. So what should you watch instead of vibes? Watch behavior. Is volatility expanding into vertical daily ranges? Are people using leverage because it can't lose? Are premiums and availability still tight even when price pulls back? Do dips get bought faster than before? Those are the tells. Now, I'm going to give you a framework that keeps you sane when the ratio is moving fast. Think in routes, not one outcome. Route A, the grind up, higher highs, ugly dips, then higher again. Route B, the stall. Price goes quiet for weeks, boredom shakes out the crowd, then the next leg starts. Route C, the punch in the mouth. A liquidity event hits, everything sells off, even strong assets, and the market tests conviction hard. If you're only prepared for Route A, Route C will make you capitulate at the worst possible moment. So build your plan for the ugly route, not the easy one. Here's the practical playbook. Step 1. Define what your metals are. Are they insurance, a cycle position, or a tactical trade? If you don't assign a job, the market assigns one for you. Step 2. Split into 3 buckets. Core, the part you don't touch because a number got loud. Tactical, the part you rebalance if your allocation gets too big. Opportunity, dry powder for the ugly route. Step 3. Track the ratio like a dashboard, not a deity. If the ratio keeps compressing, silver is still leading. If it pops higher for a while, that might be a reset. If it rips higher with silver, failing to reclaim key levels, that's when you respect a regime shift. And step 4, don't confuse nominal targets with a plan. Big round numbers create drama, but drama is not your friend. Your friend is process. Now let's answer the question behind the question. What does $5,000 gold plus $121 silver actually imply? It implies that the market is repricing the measuring stick. It implies that real assets are being treated less like trades and more like anchors. And it implies that silver, because it's smaller and more industrial, can become the pressure valve. That's why the ratio flip matters. It signals that silver is no longer being treated as the side character. But listen, higher doesn't mean safer, it means more volatile. And volatility is how the market transfers positions from the impatient to the prepared. Now, let's zoom in on why silver is the metal that makes people do dumb things. Gold can trend for months with relatively smooth pullbacks. Silver can do the same trend in 1 week, then give back half of it in 2 days, then rip again. That's not broken. That's the normal personality of a small market with big demand and a lot of paper activity on top. When silver hits an ATH, 3 groups collide. Long-term holders who finally feel relief and want to lock a win. Late buyers who chase the move and are terrified of being last. Professionals who know exactly where stops and emotions are clustered. That collision creates the classic pattern. Push up, air pocket down, then a brutal decision point. Most people make that decision with adrenaline, not rules. So make these decisions before the next candle forms. Decision 1. Your sleep at night size. If a 10% drop would make you angry, anxious, or impulsive, you're too large. Decision 2. Your rebalance trigger. Pick a number, not a feeling. Example, if silver grows beyond X% of your portfolio, trim a small slice back to target. Not because you're bearish, but because you're managing survival. Decision 3. Your ad zones. If you're waiting for the perfect dip, you'll either never buy, or you'll buy only when it feels safe, which is usually late. Instead, choose 2 or 3 zones where you'll add in pieces if price comes to you. Now back to the ratio in plain language. A falling ratio means silver is outrunning gold. That's often when the crowd shifts from protection to performance. But it also increases the chance of violent pullbacks, because silver heats up faster than gold. So use the ratio as a pacing tool. If it drops fast, respect the volatility phase. If it stabilizes, respect the digestion phase. If it rises sharply while silver can't reclaim levels, respect that the baton may move back to gold for a while. What if this is the top? It might be a local top. Markets breathe. But cycle tops usually come with a mania narrative spreading outside the usual crowd, plus reckless leverage turning pullbacks into liquidation cascades. If you're not seeing that full cluster, don't assume the final act already played. And if you have 0 silver right now, your enemy is not the price. Your enemy is hesitation. Start small, start disciplined, and build in pieces. Remember this sentence: gold is the signal, silver is the amplifier. If you remember that, you stop panicking when silver acts like silver. One more thing that keeps you out of trouble: separate price action from position logic. A headline candle can be nothing more than a liquidity sweep, a margin-driven flush, or a simple premium reset. So watch 3 real-world signals alongside the chart: dealer premiums, delivery delays, and the ease of sourcing size. If price dips but those frictions stay tight, that's not a collapse, it's compression. Quick self-check. Are you holding a position you can afford to hold through a nasty week? Do you have dry powder for the ugly route? Do you have rules written down, or are you improvising under stress? If you can answer those, the ratio flip becomes opportunity, not anxiety. And if you're already up big, consider trimming the emotion, not the thesis. Take a tiny profit, raise cash, and let the core ride. That way you reduce pressure without abandoning the setup. The goal isn't to win the day, it's to still be in the game when the final leg arrives. Calm beats clever in metals, always. Breathe, then act, now. So here's your closing checklist for the next 30 days. 1. Don't sell just because you're excited or scared. Sell only when your rules say so. 2. Expect whiplash. A fast $8 or $10 move can happen without warning. If that would break you, you're oversized. 3. Watch the ratio, watch volatility, and watch real-world friction. Those 3 together tell you more than any headline. And 4. Stay liquid in your life. The fastest way to lose a great position is to be forced to sell it. Final cliffhanger. The next shock in this market won't arrive when everyone is cheering. It arrives when the comment section gets quiet and people decide it's over. That's when the next leg is built. If you want, comment one word, ratio, and I'll pin a follow-up with the exact signals I'm watching for the next flip and the next shakeout. Educational only, not financial advice. Manage risk, stay calm, and I'll see you in the next update.